Hello, this is Dominica with Easynomics, and today we are going to break down our evaluation of theory of the firm. How do we evaluate, compare, and contrast the different market structures? How do we organize our thoughts? And so that is the point of this video. This will be an extension of 3 videos that I created. These will be linked in the video notes below within a playlist. I have a couple of playlists within Theory of the Firm, one focused on monopoly, another focused on monopolistic competition, oligopoly. And within that playlist, I have 3 videos that we can see here, number 11, 12, 13 in this particular playlist, where I'm comparing and contrasting perfect competition, the industry and the firm, with its polar opposite, monopoly, and going over the talking points of allocative efficiency within those market structures and productive efficiency within those market structures. In this video, we're going to go over that again, but then we're going to continue to expand on other talking points that we can use to evaluate these market structures. So it's too much to compress into one video. So there's going to be a series of videos that will be linked to each other. This will be the first. And as I mentioned before, in this video, we're going to again focus on allocative and productive efficiency. In the next video, we'll then look at the price elasticity of demand within the industry of perfect competition versus monopoly versus monopolistic competition. And what does that mean for society, for stakeholders? Then we'll go on in other videos going over what are the benefits to society of firms sustaining supernormal profit. Yes, monopoly, there's a lot of negative aspects to it, but there's actually some positive aspects to that. With monopoly or monopolistic competition, when they are able to sustain supernormal profit, they can invest in research and development, economies of scale. So we'll cover that in that video. Then we'll move on to discussing asymmetric information versus symmetric information. Symmetric information within perfect competition versus the asymmetric information that exists within monopoly market structures and so on. And in other videos, we'll go over how do we improve outcomes within society? How can the government improve these outcomes? So we're going to look at economic policies, government interventions to increase competition within market structures. And then we'll also look at perfect competition and how the government can also protect firms within the domestic industry that are facing volatile global prices. And then we'll get into government interventions, policies that can improve asymmetric information. So that will be the goal of these series of videos. So right now we're going to first look at the first 2 points, refresh our memory on allocative versus productive efficiency across these market structures. So let's get into that, and then I'll stop, and then later there'll be other videos going over these other talking points. And hopefully this will be a good way for you to think about how you can take past microeconomic knowledge, PED, when we get into the solutions of government intervention, price controls, subsidies, etc. And so you can kind of weave it together to achieve a high score because you're able to adapt your thinking and see how these things connect to each other. So let's go ahead and first get into allocative and productive efficiency. Okay, so let's walk through these talking points. So allocative efficiency, if you haven't done so already on your paper exam, you should go ahead and define it, demonstrate your knowledge of the language of economics. Allocative efficiency is referring to the allocation of our scarce resources, and we want to allocate them efficiently to produce the combination and quantity of goods and services that are desired by society. And in theory, that would be achieved where the marginal benefit equals the marginal cost. If we're able to get MB to equal MC to intersect, we are achieving allocative efficiency. So graph A and graph B is perfect competition, and we're looking at graph A, the global industry, or the industry, and the individual firm for graph B. So within perfect competition, referring to our model, we want to refer to the models that we've drawn, we can state that the industry is always allocatively efficient regardless of the quantity of output, because we can see that the global demand, if this is the primary commodity market for petroleum or natural gas or timber, the demand equal marginal benefit will equal the global supply equal to marginal cost at point A. And so we can see at point A in graph A, marginal benefit is equal to marginal cost, and thus consumer and producer surplus would be maximized. So here we see consumer and producer surplus would be maximized. In addition, we can move on to the firm in graph B, and we can state that the firm is allocatively efficient as well, always, because regardless of the quantity of output, we're going to see that marginal benefit also equals marginal cost. You might be thinking, well, wait a minute, isn't the firm trying to maximize profit? Aren't they trying to pie for profit, maximize profit, producing where MR equals MC? That is their goal. So we can see at point B, marginal cost is equal to, here's the extension of that perfectly elastic demand curve, it's equal to marginal benefit. And so the firm at point B would be profit maximizing. But with perfect competition, because the demand curve is perfectly elastic, we can see that price equals demand, which equals marginal benefit, which equals average revenue, which equals marginal revenue. So here we can see marginal cost equals marginal revenue. So the firm is profit maximizing at that point, but it's also equal to price, equal to demand, equal to MR, equal to MB. So here we see MB equals MC. So the individual firm is also allocatively efficient. Now we're going to move on to graph C and graph D. Graph B is our monopoly. They're maximizing profit at quantity M for quantity monopoly. And we have the price set by the monopoly. They're going to price high at P, price for monopoly, with costs for the monopoly. And we can see that with monopoly, monopolistic competition, oligopoly, including graph D, that marginal benefit does not equal marginal cost. We can see that at QM, point D, marginal benefit is greater than at point F, marginal cost. All right, so here we can see marginal benefit is greater than marginal cost, so the firm is allocatively inefficient. They are under allocating resources to the production of goods and services versus what is desired by society. They're not meeting society's needs and wants. It would be allocatively efficient if MC equaled MB at point C, but the monopolist is not there. They're at QM, and at QM, again, we can see MB is greater than MC. The same case for monopolistic competition at its long-run equilibrium of normal profit. Again, we can see at quantity marginal cost, I'm sorry, not marginal cost, but quantity of monopolistic competition, the firm at MC, monopolistic competition, we can see that at point I, marginal benefit is greater than point J, marginal cost. Again, under allocating resources. And in addition to that, we can see that price is increased as a result of the under allocation. We can see, let's use another color, that the monopolist has the power to raise price, and that's going to reduce consumer surplus. Consumers will pay a higher price versus the price that they could have got with perfect competition. So P for price for perfect competition is less than price for monopoly. And the same case for monopolistic competition. The price in the long run at normal profit for monopolistic competition is going to be greater than the price at perfect competition. And that's going to reduce consumer surplus. And it's going to increase producer surplus. The increased price increases producer surplus. If I was to highlight that area, see if I can highlight the reduced consumer surplus. Let's go ahead and do that. Yeah, that color is fine. All right, even though it's cut off, this is the consumer surplus. All right, reduced due to that higher price. Whereas we're in the industry, we get a greater consumer surplus because there's a lower global price there. Okay. And again, we can see with monopolistic competition, the consumer surplus is reduced due to the higher price, and the consumer surplus, the producer surplus would be increased. Okay. If I was to maybe shade in the area for producer surplus, it would include this area. So it's the area under the price down to the marginal cost curve. All right, we have an expanded producer surplus area versus this producer surplus area within the industry of perfect competition. Again, with monopolistic competition, we can see an expanded producer surplus area there. Okay, so that covers allocative efficiency talking points for perfect competition, industry firm versus monopoly and monopolistic competition. Now let's move on to productive efficiency. So now let's get into productive efficiency. So again, if you haven't done so on your paper exam already, you should define productive efficiency. And that is, in theory, for higher level students, stating where the firm is producing at minimum average total cost. The costs on average are at their lowest point. And so we're not wasting our scarce resources. We're using all of it that is going into manufacturing and production. With perfect competition, the benefit of perfect competition, referring to our models, that the firm is productively efficient in the long run, as at the quantity where profit is maximized, where MR equals MC, the firm produces at minimum ATC. So we can say in graph B, the firm at quantity of perfect competition, the firm is maximizing profit at point B, but we also notice that they are producing at the lowest point for ATC. ATC here is at minimum. Minimum ATC is achieved. So the firm in perfect competition in the long run, because they face so much competition, they're under tremendous pressure, they don't waste their scarce resources. They are productively efficient, which is what we want. Our resources are scarce. We don't want to waste them. So that is a pro, that is an advantage of the firm within perfect competition. But we can also mention that in the short run, the firm may be operating at supernormal profit or may be generating losses. And if that is the case, then we'll see that ATC is greater than minimum. There will be periods in the short run where the firm is not productively efficient, but in the long run, they are productively efficient. So that is a pro of perfect competition. How about monopoly? Whether it's monopoly, monopolistic competition, or oligopoly, referring to our model, we can say that at the quantity of output where MR equals MC, it's allocatively efficient, and we also see that the ATC is greater than minimum. So in graph C, with our monopoly model, at quantity of monopoly, we can see at point E, and I'll draw a line that at point E, we can see that ATC there is greater than minimum ATC. So the monopolist, since they face no competition, they're under very little to no pressure to really maximize the use of their scarce resources. They can get away with some waste. And with monopolistic competition, even at its long run equilibrium, we can see at point I there, right? We have ATC being tangent to our demand curve. At point I, again, we see that ATC is greater than minimum ATC. So monopolistic competition is also productively inefficient. Why would the firms in monopoly or monopolistic competition or oligopoly be productively inefficient? It could be due to such things as, this is a key term, vocabulary, excess capacity, and we can explain what excess capacity is. We can give an example. For example, we can talk about how hotels and restaurants have periods during the day where there's reduced demand. Between breakfast and lunch, there's reduced demand. You have excess capacity, you have tables, you have wait staff that they're not producing because there's little demand. You might have a hotel in the low season. You have excess number of rooms that are unoccupied, and that's going to raise the cost on average during that period of time for those firms. In addition, we can argue that productive efficiencies exist within monopolistic competition or oligopoly because firms in those market structures invest in advertising and marketing their products to differentiate themselves from the competition, and it can be argued that the financial capital spent on advertising and marketing raises costs of production. So that's going to raise the ATC because of the expense of advertising, marketing, and so forth, and that can be considered contributing to productive inefficiencies within those firms, a waste of those financial capital resources by the firms to spend on that. Okay, so those are some main talking points within productive efficiency and allocative efficiency. That's the goal for this video. And the next video, we'll go over price elasticity of demand and other talking points for evaluation for theory of the firm. If you have any questions or comments, please feel free to comment in the comments below. And always don't forget to subscribe and to like and to show your support for our channel, Easynomics. Thank you so much.